Hello and welcome to Dollars and Making Sense, a weekly program about finance, money and investing. I'm your host, Ray Treverson from OTG Capital, and I have with me today from Services Australia, back again, Justin Bott. Welcome to the program.
Thank you so much, Ray, for having me back.
Wonderful. Now, for those of you that are unaware, we normally broadcast on Radio Northern Beaches and also nationally to the Community Radio Network. And so for all of you out there, we'd love to hear from you every now and then. So don't forget to drop us a line every now and then, as well as I'm sure, Justin, you're online and your agency at Services Australia is always more than willing and happy to help people out. And today, I guess it's another one of those opportunities, I think, for education. Last time you were on the show, we talked about assets tests and the aged pension. And again, I learned a lot. And again, today we are talking about annuities and income streams.
Superannuation and income streams.
Okay, so I'll hand over to you because what we're really trying to do is get a lot of good information over in a short amount of time. So over to you.
So the main focus is going to be on how does Services Australia look at superannuations and account-based pensions. And the reason we're focusing on account-based pensions is when it comes to retirement planning, they are, I don't know, potentially the biggest, certainly one of the biggest options that you're going to use with your superannuation. Mm-hmm. So let's start with the simples. Let's start with superannuation and how Services Australia looks at it. And really, it depends on what stage of life you're at. So for people who are under age pension age, which is now 67 years of age, your superannuation is an exempt asset, meaning Services Australia doesn't look at it when we assess any of your payments. It doesn't affect any job seeker payment, parenting payment, disability support pension, or anything. So as long as it's in superannuation, and when we're talking about superannuation, we mean the whole concept of the accumulation stage. The money goes in, nothing's coming out. When you're in that contribution stage where you're taxed at your 15%, when you've got lack of access to capital, while it's in that stage, it does not count for Services Australia against any of your pensions or your payments.
Okay, and I think it's important for people to understand that it's not just the industry or APRA approved super funds. It could be a self-managed super fund. It could be a regulatory savings plan that is covered under superannuation law. And again, some people are surprised to find out that there are more than one way. There's more than one way to actually invest money for your retirement. And super, I think, is the primary one. And I think it comes to mind very easily because certainly the industry funds do a lot more advertising these days than they have in the past. And again, when you wrap numbers around it, people ask me often, the super industry now is over $3 trillion. It's huge. It's huge. And so, born, to dare I use the, from little things, big things grow. But I mean, dare I say, when Paul Keating devised the system back in 96 and legislated it, here we are coming up to 30 years and it's been a pretty big success. And so it does have impact, but I think fascinatingly, so you're telling me that if somebody's got even a couple of $1 million in their super, that does not impact their Services Australia payments?
When they are under age pension age. Again, because the main purpose of superannuation is to look after you in retirement. So the basic premise is that we don't want people to be touching it if they don't have to, because we're not going to assess it as part of their payment for age pension age. When you turn age pension age, though, that's a different story. And I will agree with you. When we use the term superannuation, certainly self-managed superannuation fund in accumulation phase is exactly the same. The rules are exactly the same for a self-managed super fund in accumulation as it is for a standard superannuation phase through an industry fund or a retail fund or whatever you're going.
Excellent.
But the moment you turn age pension age, your superannuation now becomes a deemed financial asset, which means it's going to be assessed the same as if you had that exact amount of money sitting in the bank account or sitting in a share portfolio or whatever it might be, deemed at what is presently 0.25 and 2.25%.
Now, I'll just pick you up very quickly. I always like to hopefully explain terminology, and deeming is something that maybe not right now, but let's maybe cover off what deeming means in a Services Australia context. But please continue on with the income streams. Yes.
No, yeah. So understanding how we assess income streams and super means you do have to understand deeming. So it is worth going into. So deeming is the way that Services Australia assesses income from what we describe as financial assets. Now, your financial assets are your bank accounts, your shares, managed funds, loans that you have made to other people, superannuation when you're over age pension age, some income streams like account-based pensions, and some gifts that you've made. And what we do with those is we look at all of your financial assets and we add them all together to come up with a total. And then we apply a fixed rate of interest. So we deem or decree or declare, if you like, that you're receiving a fixed rate of return from those investments, whether you're getting it or not. And that fixed rate of return, it's different if you're single, a member of a couple. The interest rates are the same, but where they come into play are different if you're a single member of a couple. But it's basically 0.25% for the first roughly 60,000 if you're a single person, or 100,000 if you're a member of a couple, and then 2.25% interest from everything over that. And that's the income that we say your financial assets are generating. Even if you've got all that money sitting in Milo tins at home earning no interest, or you have it sitting in a share portfolio giving you dividends, which are the equivalent of 7 or 8% return, it's still going to be deemed at that 0.25% and then that 2.25% interest rate.
Now, how do we come up with those numbers? I mean, are they reviewed regularly? Because we all know that certainly in the last sort of 12, 14, 18 months, interest rates have not been stable and stationary by any stretch of the imagination. Do they ebb and flow with the RBA cash rates as well?
They aren't actually directly linked with the RBA. And right now we're in a little bit of a different situation because the deeming rates have actually been frozen at that 2.25, 0.25 and 2.25% until the 30th of June next year. Okay. So they're not going to be moving for another 11 months, and then we'll see what happens after that. But they don't officially move with the official interest rates. They are actually a separate act of government when the deeming rates do change. So just because the official interest rates change doesn't mean the deeming is going to change, and it doesn't mean the deeming has to wait for the official interest rates to change if it chooses to. But right now, nothing's going to happen for at least 30th of June 2024.
I guess in asking, I guess I'm curious then, is that good or not so good for the recipients?
Oh, deeming's great. A lot of people may have issues, but I'm a massive fan of deeming, and there's a couple of reasons. The first one is that because it's fixed at these rates, if you get income over that, that's just money in your pocket with no effect on your pension. So the first thing is that, again, if I had that share portfolio that was giving me dividends at the equivalent of 7%, the fact that I'm 4 and a bit % over the maximum deeming rate is just money in my pocket with no effect whatsoever on my rate of payment. So that's your first big benefit of deeming. It's whether you get over or under is your choice, but deeming is the fixed rate. So if you get over, that is your money. But of course, as you know, there's no point trying to pursue an investment that gives me 7% income if I'm not prepared to deal with the consequences of investing in something that gives me 7% interest. So
shares go up and shares go down.
That's exactly right. So with the idea of higher levels of return, there's more than likely going to be that link with higher volatility in prices. To pursue those higher levels of income, I have to be prepared to deal with the fluctuations in the market and the increased chance of loss. So there's always that. But from a deeming perspective, there's no penalty if you choose to go for higher levels of interest. From a deemed account-based pensions perspective as well, what I choose to draw down from that account-based pension or that self-managed super funding pension mode, for most cases now is deemed, again, at that 0.25 and the 2.25% rate. So if I choose to take my 5% minimum because I'm 66 years of age, we will still deem it at 2.25% at most. So again, I'm getting more income in my pocket and it's not having an impact on the rate of pension that I'm getting. So that's one big benefit of deeming. Wonderful. Second big benefit of deeming is that because the income actually isn't affecting my rate of payment, I really don't need to tell you about big changes in my income. I need to tell you about changes in my balance, but I don't need to tell you about changes in my income. So if the dividends from a share portfolio are higher than expected, good for you. What I need to tell Services Australia is that my bank account may have gone up by more because, maybe all of the dividends just all got paid at the same time and there was a significant jump in my bank account. But I'm telling them because there's an increase in my bank account, not because the income or the dividends were more than I expected or less than I expected or whatever it might be. It really doesn't matter because, again, it's still deemed at those fixed rate of return. So my reporting is easier. And the one that I actually like the most about deeming is the fact that if Services Australia treats bank accounts, shares, managed investments, loans to other people, superannuation and account-based pensions all exactly the same, then Services Australia is no longer a reason why I would choose to invest in bank account, shares, managed funds, loans, superannuation or account-based pensions. So I'm not using Services Australia as a reason for choosing one financial product over another. Okay. And I can then focus on what's good about that product. What do I like about shares in comparison to bank accounts? What do I like about superannuation in comparison to a managed fund? Focus on the product themselves as the reason that I choose to purchase them for my retirement, not focus on the impact it's going to have on my pension because the impact on my pension is going to be the same. So it takes Services Australia and it takes the age pension out of my retirement investment strategy with those sorts of products and lets me just focus on the good and the bad of the products in themselves.
Wow, that makes a lot of sense now that you say it out. I mean, this is, again, great education for me and I'm sure for our listeners as well, because, I mean, I wasn't aware, and being able to do that, it also takes any potential political sting out of, people waiting one way or another, between one product or another. If you treat them all the same, that's great. So look, it's about time for a break here on Dollars and Making Sense. I'm here with Justin Bott from Services Australia, and we'll be back in just a moment. Hi, and thank you for listening to Dollars and Making Sense, a weekly radio program about finance, money and investing on Radio Northern Beaches and nationally on the Community Radio Network around Australia. The views, comments and opinions aired during our program should not be construed or viewed as financial advice. Any commentary is general advice only and does not take into account your objectives, financial situation or needs. You should consider whether the advice is suitable for you and your personal circumstances. If in doubt, you should contact an authorised licensed financial planner. We welcome questions and feedback, and you can get in touch with us via our blog, social media channels or email. Please search for Dollars and Making Sense in your favourite podcast platform or check out our blog at otgcapital.com.au/blog. And welcome back, ladies and gentlemen, to Dollars and Making Sense, a weekly program about finance, money and investing. I'm here with Justin Bott from Services Australia, and I'm your host, Ray Treverson. And today we are talking everything to do with super, income streams and aged pensions. And Justin is here as the media contact from Services Australia to talk about account. And we're now going to move on to account-based pensions and super funds in pension mode, because before the break, we were talking about pension funds in accumulation mode. So now we've taken the shackles off. We're on pension mode. We've retired. Okay, Justin, over to you. What's the impact?
All right. So we were giving a hint on this beforehand that for people that are underage pension age, your super is an exempt asset. But that exemption doesn't count if you have moved that money into an income stream, whether that be an annuity, or in this case, we're focusing on these concepts, these account-based pensions. So whatever age you're at, the account-based pension is an accessible asset for Services Australia purposes. So one of the things you'd be looking at is if you or your partner are underage pension age and you're looking at moving your money into super and one of you may be getting a payment, moving that money into an account-based pension before they turn age pension age is going to make it that accessible that much earlier.
Now, I might just quickly jump in there. An account-based pension, ladies and gentlemen, is where you just give a big chunk of money to somebody like a super fund or an insurance company or an investment company and say, here's a big lump of money. Now pay it back to me hopefully with interest over the next 10, 15, 20 odd years. That's roughly what we're talking about, aren't we, Justin?
Yeah, it is. The difference between that, though, and say your normal investment is this idea that regardless of the return of the investment itself, you actually nominate the amount that you want to be paid for the next 12 months. So with an account-based pension, it is your superannuation money. You've invested in superannuation money, so it's been in that reduced tax superannuation environment, and it now moves into, assuming you're over 60 years of age, is now moved into a 100% tax-free income source for you into your retirement. So there's no tax on the pension that you receive. There's no tax on any lump sums that you take out of it. There's no tax on any investment earnings that it makes within it. And there's no capital gains tax on any assets sold within it. So it's this very nice tax-friendly environment where you actually choose the income. So you've now got control over the income that you're taking from the fund. And that's what makes it very different from a lot of other investments. You don't have that combination of growth-based assets that you could get through an account-based pension plus control of the income that you choose. So with an account-based pension, 1st of July, you will be asked to nominate within limits. So there are minimum amounts that you're required to take by law, but you'll be asked to nominate an income that you take from that fund. And whether you choose to get it 6 monthly, every monthly, once every 12 months, that is the amount of money that will hit your bank account from the 1st of July to the 30th of June. And that's what you get paid, regardless of whether the account-based pension earned that amount, exceeded that amount, made a loss. Any of those things could happen. But those are irrelevant because you're going to be paid the amount of money that you get. So the basic premise that I say with an account-based pension is that the payment that you receive is actually going to be a combination of the investment return, but backed up by the capital within the fund.
So that big lump of money that you put in there.
The big lump of money that you put in
itself.
and invested. Yep. So underlying any source of payment that you receive from the fund, depending on how the market has performed, there's always a possibility that you are actually being paid part of your capital as a repayment to generate that income that you've nominated for retirement.
And that's we digressed a little bit. So now we're going to be talking about how these impact what happens at Services Australia.
Yeah. So from a Services Australia perspective, this is another one of those deemed financial assets. For most people, this is a deemed financial asset, which is why it's actually very easy. So from a Services Australia's perspective, it's an asset. So we're going to count the balance and the income is going to be deemed. So what you choose to draw down is really irrelevant. It's going to be the 2.25% or the 0.25%, depending on the total balances that you have with all your financial assets. So that's as simple as it gets. The tricky part comes from what we call a grandfathered account-based pension. And they're still around, definitely are, but there aren't as many as there used to be. Now, a grandfathered account-based pension, what happened for them, and if you've got one of those, you probably know you've got one of those. This is nothing that a new customer from Services Australia can get. So to have a grandfathered account-based pension, it means that you've had this same product since the 1st of January 2015, and you've been on pension continuously since the 1st of January 2015.
Right. So you're in the system and you've been there for a while and you know what's going on.
That's exactly right. So you've been used to this product because you bought it before that date. You're used to how it goes, and you're used to how the product works. Nobody now can apply for a pension and get a grandfathered account-based pension. It's not possible. Everybody from now will be a deemed financial asset. So very simple. If you are with one of those old grandfathered funds, it's a very different and much more complicated story. The assessment of income is based on a very complicated formula, which takes way too long to explain.
I'm showing the listeners right now pages and pages that I downloaded off the Services Australia website. Believe me, ladies and gentlemen, if you don't need to read this, don't. Okay, it's busy.
Yeah, there are only a couple. There are two main tips that I would say for anybody that does have a grandfathered account-based pension that anybody with a new product just doesn't have to worry about. The first thing is how much you choose to draw down can actually have a significant impact on the pension. So the more you choose to take, the worse it could potentially be for your pension. But even more of a potential issue is if you ever need to take a lump sum out of the funds. So if you ever want to take some money out to pay for a holiday, do renovations on the home. That's all fine, and it's your money to do that. But if it's a grandfathered fund, it can actually come with an unexpected and unpleasant consequence. So anybody who has a grandfathered fund that is either looking at doing a significant variation on their income or thinking about taking a lump sum out of the fund, please call Services Australia's Financial Information Service first. So give us a ring on 132300. The number again is 132300, and say the words Financial Information Service when you're asked for the reason for your call. That will put you through to one of our Financial Information Service officers who will be able to explain to you, because you will be a Services Australia customer. You have to be one to have a grandfathered fund. They will explain to you what the implications of a lump sum withdrawal of that fund could be, and talk about other options that might be available, because it could be actually much more significant than you thought and could have a much worse consequence than you thought. So give the Financial Information Service officer a call before you do anything, because we can't help you if you've already done it. It's done and it's unable to be fixed. So give us a call before you think of doing anything, and we can help fix that one for you.
Okay, so super funds in pension mode. What's the story there?
Self-managed super fund in a pension mode, everything I just said, exactly the same applies. So if I had a self-managed super fund in pension mode, and that's been in existence since the 1st of January 2015, and I've been on a pension since the 1st of January 2015, those same rules, same implications apply. So if I'm thinking of taking a lump sum out of those, again, same thing. Call the Financial Information Service, talk it through. Other than that, it's a deemed financial asset, same as it is for everybody else. So with a self-managed super fund, we actually, apart from the fact that we can't get the information automatically from a fund provider, which we do with a lot of industry funds now and retail funds, apart from that, the way that we look at those is exactly the same as the way we would look at an account-based pension or your superannuation in accumulation. The fact that you're managing it yourself, that's for your decisions and your investment choices, makes no difference to Services Australia.
I guess what's fascinating me, and we talk about SMSFs on this show a lot, and given the design of the super system, going back almost 30 years now, the whole design was so that, fingers crossed, we get to a point where we won't need to be drawing an age pension from Services Australia, because our superannuation guarantee is such that we've built up enough of a nest egg. I'm just curious, Justin, from where you sit within Services Australia, are you seeing this gradual shift, more and more so, particularly people with their own SMSFs now are not necessarily even compliant or able to draw an age pension because they've accumulated enough money that they actually don't qualify anymore?
In a lot of cases, we wouldn't know because they never come to us to have a chat in the first place.
There you go.
Normally, certainly if you are engaged with your self-managed super fund, then that means that you're engaged with, generally speaking, your entire retirement planning, which means you know your assets limits, you know the pension limits, and you know you are or aren't eligible, and you do or don't bother applying if you aren't. Or you've got a professional who's actively watching that for you. So first thought is, you may not be eligible for a pension, and we're not going to go into details here, but have you applied or are you eligible for a Commonwealth Seniors Health Card, which is a concession card for people who are over age pension. There we go. Who are over age pension age, but who is not assets tested is the big thing. So again, go to the website servicesaustralia.gov.au to find out about the Commonwealth Seniors Health Card. But the second thing is, if you have such, just because you're not eligible for a pension now, doesn't mean that you're not ever going to be eligible for a pension.
Okay, if your SMSF comes down to a certain level, it may not be enough, and that's when you might then kick in.
By the very nature of moving it into pension mode, as you know, those minimum amounts get bigger and bigger and bigger as you get older and older and older. And it becomes, we become more and more conservative. Our ability to generate income reduces. So theoretically, the income from our investments is going down, whereas the required drawdown from the pension is going up, which means capital is coming more and more into play. So we're using up our capital in an account-based pension more and more, which is what they are designed to do. They are designed.
Yeah, I was about to jump in there and say, and that's exactly the way it was designed, so that the older you get, the less you have. And again, the numbers vary, but between 90 to 91, 92, 93 or thereabouts is when you should actually theoretically have no super left.
One of the jokes is that a perfect account-based pension is the one that runs out of money on the day that you die. They're not supposed to. So the way that I look at it is that this is the money that you have been saving during your working life to look after you in your retirement. But the point is that as those balances go down, you might not be eligible for pension now, but in 5 years, 10 years, 15 years time, you may be.
Could be, yeah.
So it's not the fact that you're over now. And the biggest concern that we have is for people who try and come up with tricky ways to speed that process up, and actually financially shoot themselves in the foot by missing out on access to capital and a decent amount of income to try and get a pension the most sooner, when it's going to come, or theoretically it should be coming. At some point in the future, that pension eligibility will exist. And again, if you have the professionals watching over you, then they're aware of what the limits are and they're aware of your balances, and they should be letting you know, look, we just had the pension rate went up on the 20th of September or 20th of March, which it often does. You look like you're eligible. Get that application in and let's start going. So just because I'm not eligible now doesn't mean I won't be eligible in the future.
Justin, again, look, we're out of time now. A fabulous show, a really wonderful education. Again, I've learned a lot of really good information, and we'll put some links in our blog that we publish, and we'll put those in Spotify and the YouTube channel that we push this out to as well. Justin, always a pleasure from Services Australia to have you on Dollars and Making Sense. We'd like to welcome you back again in the near future, and thank you for being on the show.
Ray, it is always a pleasure, and I'd love to come back. I enjoy all of this.
Wonderful. Have a great day, and thanks.